everyone, to the Adjusted for Risk podcast here from the shores of Lake Tahoe. So today I have a great show planned and a very special guest here with us. I'm very excited to have Deborah George on the show, which is sure to be a great conversation and one that I know I'm going to learn a lot from. That's why I'm so excited for it. Deborah is a wealth of knowledge in the emerging manager space. So it's time for me to stop talking and let's get to the start of the show. So Debbie is the president of Growing Emerging Managers Services, which is a marketing firm she formed in 2005 that is dedicated to building strong businesses for the best emerging and undiscovered investment managers. She builds tailored plans from marketing strategy to discrete product positioning and presentation design to full service marketing programs. Debbie has deep expertise in the emerging manager space. She focuses on making a manager irresistible to sophisticated and institutional investors by meticulously defining their edge and carefully constructing their compelling story. She considers Zephyr her secret weapon in this quest. So thank you so much, Debbie, for joining. Let's go ahead and get started. You are the star of the show, so let's spend this time hearing from you. Debbie, let's start from the beginning. And can you just give us a brief recap of what really is an emerging manager? What consists of an emerging manager?
Yeah. So first of all, I'm delighted to be here and delighted to be talking about my favorite topic. So as a complete aside, my company has a very long, unwieldy name, Growing Emerging Manager Services, but I really wanted a diamond for the logo, so hence GEMS. But anyway, here we go. So so I've actually spent my entire career working with emerging managers, and I've seen them I've seen the evolution of what they're called and described at go all the way from boutiques, which is what they were called early on, up through minority managers, and then the MWBE, which is minority-owned business enterprise, woman-owned business, or disabled veteran. And at this point, the name of the category has morphed to emerging and diverse. And I think that that's a very, very good name for the space, a good name to describe the types of managers that are being looked at. At the end of the day, when people want to work with emerging managers, it could be for two reasons, and usually it's for both. One is kind of to do the right thing, to get underrepresented folks into the asset management mix. But the other reason, and probably the most important reason, is that it's been shown over and over again that smaller managers can really provide better alpha at times, most of the time, than larger managers. Well, I'm biased, what could I tell you? So, just in terms of defining it today, size does matter. So who's an emerging manager? For long-only strategies, generally it's under $2 billion in assets. Sometimes it's under $1 billion, sometimes it's under 10 billion. I think ISB, Illinois State Board, considers it under 10 billion. But and then for most people, they define it on the private side as fund 1 or 2. And I guess the wealth management area so that would be for the pension side of the business, pensions, endowments, foundations. The wealth management side of the business is also looking for obviously good alpha, and they can be a really nice way to grow your assets, but they usually have a hurdle of at least 100 million under management in the strategy. So that can be a bit tough for someone trying to raise assets, whereas the stricter definition, where it's just under 2 billion in portfolio assets, really strategy assets can be anywhere from 0 up to, even $1 billion. So that's kind of where it's morphed. I think emerging and diverse is a good name for it. And here we are.
That's a great way to start this, Debbie. And to go back to the name, do you think It's kind of in a way like ESG. ESG's morphed a lot, right? From socially
Yeah.
responsible to now ESG. Do you think that's kind of hurt maybe the space a little bit? Is how it's evolved in the name? People might have thought, boutique or minority, emerging, now emerging and diverse. Um, I feel as if consistency is key. And, maybe having a set name helps this space. Do you think it's kind of held it back a little bit?
I think that's an interesting question. I think that it has. I think that there was a lot of pushback when it was called minority
Mm.
managers. And just for the history, California, I believe, California PERS, the state of
Yep.
California. So PERS
Mhm.
and STIRS actually were two of the first players in this space. And it was, I want to say Proposition either 13 or 74, I forget which it was, but it was actually voted into law back in I think in the 70s. And there was so much pushback that eventually that got overturned. So that did not sit well, and it just didn't sit well in the
Yeah.
industry. To fast forward to where we are today, that's why I really like emerging and diverse. And let me just digress for a second and tell you why I like it so much. Actually, I digress a lot and all the time. But anyway, I really like it because so this book really is a terrific book. You didn't think I was going to hold up a book, but it's called Rebel Ideas by Matthew Syed. And he does a marvelous job of outlining how important diversity of thought is to solving complex problems. And investments are complex problems.
Hmm.
Investments are complex. And the book goes through a lot of different ideas all related to that concept, starting with September 11th and how we missed all the signs. But not to get so much into the book, that's why I really like this description as emerging and diverse. There are studies that have been done. In fact, CityWire did a study of 25,000 mutual funds representing 20 trillion in assets. They sourced it out of Morningstar. And what they showed unequivocally is that the highest risk-adjusted returns were generated by mixed gender teams. So diverse teams of men and women. The study was actually called Alpha Female. So it was just looking at diversity with respect to women in the business. However, that's what they showed, is that the real alpha is coming from a diverse team of men and women. And so that's why I really like that construct. And I think that going forward, that's going to help us a lot.
That is awesome. That was a great recap there, and thank you for sharing that book. I'm always in need of new reads, so that was perfect. Thank you. So, you mentioned size does matter, and producing alpha. And all that sounds great. But I think the listeners and investment professionals want to know why use emerging markets. You mentioned alpha and size matters, but can you go on a little bit more on why use emerging managers?
Yeah, in 2005, when I went out on my own, one of the first people that I worked for is Alberto Franco, and he's a brilliant guy. As an aside, he doesn't even know he's getting a plug here, but he was the one hedge fund of funds manager who did not invest with Bernie Madoff because he couldn't figure out what the guy was doing, right? But that's an aside. But he always said, when I'm trying to look for a hedge fund guy to work with, I want to work with the smaller managers.
Mm.
And here's why. So I pretty much know everybody in the industry. And when I run into my friends from years back, whether from Citadel or whatever, you run into the small guys and you say, hey, how'd you do last year? And he goes, oh, great, we were up 21% or we were up 40%. He says, and then you run into, the Citadels and you say, how'd you do last year? And they go, great, we raised $1.2 billion in assets. And he says, who would you rather have running your money? So that's kind of, that's the short answer. Also, going way back in time, one of the portfolio managers that I was working with, I said, oh gosh, we're up again in a portfolio review. It was for IBM, who
Mhm.
was our client. And I said, we're up against XYZ manager. At the time, we were a bigger manager, but we're up against XYZ, which was a smaller manager. And I said, oh my God, they're knocking the socks off our performance. And he said, in his British accent, he said, well, Debbie, that's a ridiculous comparison because you can't do things. They can do things we can't
Mhm.
do. So it's that, more nimble,
Mhm.
um, more nimble mindset, more nimble capability, because they can move into and out of smaller names that I'm sorry to pick on a BlackRock, but that BlackRock just can't do.
Yep. I know when I started in the industry, we're advisors for or plan sponsors for our 1K plans. And that was always one issue we had with the Growth Fund of America, right? I think it was in every 401k plan out there, right? Everybody had American Funds, Growth Fund America. And we were always
Yep.
concerned just about the size of it. Can it be nimble when, there's a surprise interest rate hike or, so a black swan event? And
Right.
what you had to say there is perfect. So when you're talking size, is there like a certain like assets under management, like a break point that you kind of look for, or somebody should look for?
Well, yes and no. So the smartest people, I think, who have serious emerging manager programs. So people like the City of New York, the State of New York,
Mhm.
CalPERS, CalSTRS, Texas teachers, Texas employees, and I have a whole list. But that's a really good representation because they're very committed to the space. They're
Mhm.
committed to the space, by the way, because of the alpha, right?
Mhm.
So um, and so, those folks will start with a manager who has zero. So if a team that they know has left a larger organization or another organization, and they have confidence in the team, so I suppose that's that pedigree,
Yeah.
that we talk about, that fifth P kind of thing. Um, if they know the team and are comfortable, they're willing to be, the very first dollar. But in general, I think people want to see you at least have, again, when talking about long only strategies, not the
Yep.
funds themselves, long only strategies, they'd like to see you have, 10, 20 million, just to see that you've gotten beyond the friends and family stage. Um, but again, the best and brightest, if you have a new idea, an opportunistic idea, I think that they'll listen. So I know you asked about asset level, but I will say that regardless of your asset level, what's going to drive whether you get hired is if you're making an institutional quality presentation to them. So they want to have confidence that you understand everything that has to be done from their point of view, that you're not going to create a problem, that you're not going to go out of business.
Right.
And maybe that ties back to, assets under management as well. They want to see that you're, well financed enough. A lot of firms further down the pike, and when I'm talking about that, I'm talking about getting hired further down the pike, even though you might be a smaller emerging manager. People are going to start saying, we don't want to be more than 20% of your assets, but that's way down the pike. For people really interested in being able to take the risk and get the rewards of working with a smaller manager, they just want to see that you're up and running, and that you're going to be around, that you have sustainability, for the next 3 or 5 years.
Perfect. And we talk, especially here at Zephyr, about the quantitative side, right? Alpha, Sharpe ratio. But what you just said, when you're talking about emerging managers, you got to take a look at the qualitative due diligence too, right? And how important that is, especially if you're talking about some of these big institutional players who are relying on the pedigree, and they may not have assets under management at their new firm. Just how important the qualitative side is along with the quantitative side.
Yes, and let me just add one thing to that, right?
Mhm.
So in terms of coming across as institutional quality, when a firm first starts out, oftentimes it's just the investment team. Maybe they'll have an admin, but more often than not, you can outsource that. And so to the point of outsourcing, I don't think you lose any points at all for outsourcing your admin and outsourcing your compliance. A lot of firms are nervous about that, but that's not what we mean when we talk about having an institutional quality firm. Unfortunately, fortunately, what it comes back to, especially for Zephyr, is that's where you need the institutional quality, right? You don't want to just walk in and say, look, we're not going to lose you money. You want to be able to talk about alpha and Sharpe ratio and trainer ratio and things like that.
Fantastic. This is a great conversation.
Well, I'm enjoying
so much in the first 10 minutes of it. Where are some of the biggest and best programs that, somebody who's looking to gain exposure to the emerging manager space, where can they look, or where do they start?
Yeah, so it's interesting. So there's three ways that you can get to an investor. The first way is through the managers of managers, the moms, as they're affectionately referred to by everyone but me. And so those are people like Leading Edge, who's I'm FIS, really terrific organizations, Legato. I mean, there's a number of them, and you should definitely get to know all of them. What they're hired to do is they're hired by the larger pension funds, endowments, foundations to create a program. The reason that they're hired to create a program on behalf of that larger client is the larger clients have so much in assets that it would take a disproportionate amount of their time and commitment to monitor, to oversee, and a $20 million investment, right, with a smaller manager, which is oftentimes $20 to $50 million would be that first investment, or could be. So the managers of managers perform an added layer of oversight to the smaller managers, and oftentimes they can even make suggestions to move those managers along, which is really good. The second way is that in the beginning there was managers of managers, and now almost all of the mainstream consultants, so NEPC, Callan, Mercer, almost all of the mainstream consultants you can approach. They all have programs. I should have said Cambridge. Cambridge has long been in the business with smaller managers. But almost every one of them has a program, and they'll listen to you again, but they want you to, be able to tell your story in such a way that, that they're not talking to a creature from outer space. You need to be able to speak their language. The third way, which is a really, really powerful way, but here you really need to be ready, is, as I said a few minutes ago, so CalPERS, CalSTRS, City of New York, State of New York, Texas teachers, Texas employees retirement system, MIT, State of Michigan, Maryland, Minnesota State Board, LA Fire and Police, Illinois teachers, are all larger pension plans who will actually take a meeting directly with you. You have to be persistent. You have to be ready to send materials ahead of time. They're really, really good. They really, almost all of them have complete open doors. It may take you a while to get a meeting. And I think I forget exactly who I'm quoting, but just because I take a meeting doesn't mean I'm going to hire you. So be patient, right? But they'll usually give you a yay or nay kind of right away. So if you present something interesting and you meet their qualifications and their need, to take a step back, most of those plans mirror their overall asset allocation in their emerging manager program. So that means that if they have 50% in global equity, they're emerging in their overall portfolio, their emerging manager program will also have 50% exposure to global equity. So from that point, if they have a need you have an interesting strategy and you meet their requirements, that can be a real nice win for you. And again, you have to be prepared.
Perfect. That's great information. And I agree with you. I don't know if I really like the acronym MOMS either.
I just refuse to say it.
Yeah, this industry is terrible at acronyms, right? Everything's got in like MOMS. That's the best we can come up with, huh?
That's right. That's right.
Which asset classes are eligible? I mean, is it every asset class, certain private, public?
It is just about every asset class. It's certainly global and domestic equity and emerging markets. And then on the private side, it's private equity, private debt, venture capital to a certain extent. I want to make sure I don't miss anything because I did it in my notes. But the oh, and real estate, yes, I did miss one. And then on the venture capital, expansion capital, mezzanine financing. So it's really open to almost every asset class. There's one asset class that I think really shines in the space, really shines in the space, which is opportunistic. And I think that that's actually given more time and more lip service. That's a bad way to put it, but more time and more investment in the small space. And what that has to do with, opportunistic investments have really to do with sort of like a temporary market dislocation, something that's going to have a finite life. And that finite life may not be 3 or 5 years or a market cycle. It may be a year or two. So if you're especially a smaller manager and you can, come to a city of New York, especially, they have a pretty big opportunistic allocation, primarily in fixed income, but not only. If you can come to them and say, look, I see a market dislocation due to the price of oil, and I think, this is a 3 to 6 month opportunity, or certainly under a 1 year opportunity. Here's what would make us go long. Here's what would make us go short, or quit the program, or whatever. Would you be interested in investing? If you've got a solid thesis, you can back it up with stats. That's, again, where Zephyr can help. I know this is not supposed to be a commercial, but I do love it. So,
We'll take it, Debbie. We'll take it. We won't.
All right, good. If you can present a solid case there, that's one where it's easier to get hired, right? Because the market dislocation or some other opportunistic investment, it's not likely to be large. It could be something like a building arbitrage, and so that's one that can be really powerful.
Right. We've got towards the end of the show here. One question I presented to you earlier, and I think we should touch on it. It's been quite obvious why I was excited to have you on the podcast based on your great knowledge in this space that you share. But really, another reason is you are a very influential woman in a very male-dominated space, and I think it would be very insightful if you could provide some perspective on the opportunities for women in this space. And can you provide any hints or recommendations for women who may aspire to have a career in the investment management space?
Well, I'm very glad you asked that question. And thank you. Yes. So if I had to characterize our business, I would say that there's only one way for women to go, and that's up. The representation of women in the investment management business right now is woefully low all over the world. I think the CityWire Alpha Female Report says worldwide, the industry is 11% women fund managers, and in the US it's 10%. And that's really, really low. And despite the fact that mixed teams do better because of the diversity part of the equation. So what I think is two things. I think, first of all, that I don't think you can, 6 months ago, you couldn't pick up a newspaper and not see ESG in the headlines. Well, that's still true. But now also you are seeing a lot of DEI, so diversity, equity, and inclusion. And I think in a sense that that is easier for people to understand. I mean, the world is 50% female, so you can't hide. It's not easy to find, well, we can't find any, so that's
Right.
kind of why I think it's going in a good direction. But I think, and it isn't even a pipeline issue, because what all of the studies show is that women do fail to get promoted starting at the lowest ranks and then all the way up to the C-suite. But I digress. I think where we are now is that awareness has really hit the sweet spot, that there's not a lot of pushback. There's not a lot of action either, but it's getting to be more and more. And by action, I mean, where this is just getting taken seriously. So a lot of the consultants started asking asset managers to break down their senior staff by gender and by race. And in the beginning, they were just saying, well, don't fill it out if you don't want to. Well, let me tell you, that has changed. There is no consultant saying, don't fill it out if you don't want to. So awareness has really been brought to the forefront. And in terms of younger women in the industry, or who want to be in the industry, I would really recommend that they take a look at 100 Women in Finance. It's a great organization. It's more than 100 women at this point. It's a global organization, and it's really, really good. It's not expensive to join, and it's built on sort of a mentoring process, but not, I mean, I go and I almost always learn something. And so Amanda Pullinger started it, but she's got a terrific board of directors, and they hold seminars and things, usually in person, sometimes over Zoom. And it's a wealth of information, a wealth of connections. It's really good, and it's really going in a good direction.
Great. That's great. I know for me, I'm starting to see more and more women being highlighted, whether it's on Bloomberg or TD Ameritrade Network, Yahoo Finance. And it's great to see. I know one of the names I follow a lot is Lizanne Saunders over at Charles Schwab. The content and the thought leadership she puts out is fantastic. So it's good to see, and like you said, some more diversity, thinking outside the box, and just more, different thoughts out there can only make us better, right? In our content and research. I always like to kind of end the conversation with something fun. What's your crystal ball? It could be on this space. It could be, just in the investment management space as a whole, wealth management. The floor is yours.
Oh, that's a big responsibility. Okay, well, okay, here's my crystal ball. There was a time when I would have said avoid the wealth management platforms. Don't avoid them. It's okay. I used to say focus on the institutional end of the business. Now focus on everything. It's okay. People understand a diversified business is a healthy business. So that's number one. Crystal ball. Women are going to benefit from this DEI movement. It's the first step. Minority-owned businesses will benefit as well, but I think the groundswell is going to be women. I think the time is now. Small managers will always be in demand. I hope I outlined why. It comes down to alpha. These plans need alpha. They need it. They don't need return as much as they need risk-adjusted return. And it's shown over and over again that small managers provide that better. And then, one shameless plug is that the way you tell your story does matter. There's no, this is, you need to step up to the plate. You need to be 100% professional. You need to meet all the hurdles, check all the boxes. And if you do, my way of talking about it is, you have to tell your story in such a way that you can be first at something or be best at something. And if nothing immediately comes to mind, if you can't be first or be best, then you have to create a category in which you are first or best. And it's really just a matter of dissecting your approach and really getting to what you do better than anyone else. And if you can do that, and if your numbers back it up, it's just going to be a win.
That's awesome. I love the tell your story piece at Zephyr. We often talk about, use Zephyr to tell your story. And I think I posted this a couple of times about how important in every aspect of life, you've got to know how to tell your story, right? Whether you're selling yourself for a company or a partner, you have to sell your story. But I think in this space, in the investment management or asset management space, it's more important than ever. And I think it's important, like you said, how you tell your story, but you just can't tell a story. You got to tell it with integrity, and be professional, like you said. So I love that point. With that,
secret weapon.
Yeah. What's that, Debbie?
Oh, the secret weapon.
Yes. We love that. We love that. Don't be afraid to keep saying it. This was a fantastic conversation, Debbie. I would love to have you on again. I know you had mentioned Citadel a couple of times, and with everything that's happened with Citadel over the past year and Steve Cohen, maybe we should have you on to tell some stories about Citadel.
Oh, I don't know. I want to go up against those guys, but thank you. Well, I've loved every minute of it. Thank you so much.
Well, we'll have you on again, Debbie, to expand. This is just, I'm sure we could talk hours on this subject, and you're the premier expert on it. So thank you again, Debbie, for joining. I really appreciate it. Let's get together again soon and talk more. For all the listeners, thank you so much for watching. You can catch the Adjusted for Risk podcast on YouTube, as well as all the other places that you find your podcast or listen to your podcast, on Spotify, Apple Radio, and so on. So thank you, Debbie. Thank you, everyone else, and have a great rest of your week.
Thanks.